Hey everybody, so in this video I want to talk about Procter and Gamble. Now they recently gave us their first quarter results, and I'm not too interested about the company itself, but I am very interested in some of the things that we're seeing here. So they give us this little snippet right here, and they break out their segments. So they have beauty segment, grooming segment, healthcare segment, fabric and home care, and baby, feminine, and family care. So these are all revenue segments. Now take a look at these foreign exchange headwinds. So this is hurting revenues by 6% here, 8%, 5, 6, 5, and total, it's a 6% revenue headwind just from foreign exchange. Now take a look at the price increase. So, for beauty products, we're paying 7% more. Grooming products, we're paying 8% more. Healthcare, 6%. Family or fabric and home care, 11%. And baby, feminine, and family care, 8%. So that comes to a total of a 9% price increase. So you guys, you could essentially be having cash just sitting around and, you're paying 9% more for these products. So to me, that's pretty crazy, but that's not even the crazy part. I mean, let's just scroll down a little bit and let's take a look at what they're giving for guidance. So fiscal year 2023 guidance, it says foreign exchange is now expected to be a 6 percentage point headwind to all in sales growth for the fiscal year. Now, keep in mind, a lot of these other central banks, they're starting to pull back a little bit. They're not going as aggressive on these rate hikes. So if the United States just continues with their rate hikes, the 75 and the 50 in December, and then we just decide to hold it, while all these other central banks, if they start to cut back, then, well, guess what? The dollar is just going to be stronger and it's going to cause more foreign exchange headwinds. So let's just go ahead and see what P&G said about their outlook. So this is the concerning part right here. So it says headwinds of approximately 1.3 billion after tax due to unfavorable foreign exchange rates, 2.4 billion due to higher commodity and material costs, and 200 million from higher freight costs. Combined, these are a 3.9 billion after-tax headwind, or approximately $1.57 a share. Now, to put this into perspective, right here they're saying P&G maintained its outlook for fiscal 2023 diluted net earnings per share growth in a range of in line to up to 4% versus fiscal 2022 earnings per share of $5.81. So we are comparing $5.81 to this headwind of $1.57 per share. So this is pretty big. I mean, it's over a quarter, so it's over 25% headwind coming from foreign exchange, higher commodity and material costs, and higher freight costs. Now, there's another thing that you have to think about when you're thinking of this. So obviously, when prices are higher, it says right here 2.4 billion due to higher commodity and material costs. When the cost of the inputs are higher, obviously, you have to raise your price. So that's what they're doing to offset some of this higher commodity costs. And we saw it up here earlier, 9% increase. So yeah, that 9% increase. So that's what they're doing. Now, let's just imagine for a second that they're still serving up these same prices, but they don't have those headwinds. Well, obviously, if that happens, then they're going to have competitors that are going to start undercutting their prices. So do keep that in mind that, hey, it's a $1.57 headwind, but also, if they just kept their prices where they are right now, and if input costs do go down, then, they would have competitors undercutting them. So let's say input prices do go down. Well, then I would assume that their prices would have to go down as well because you have competitors and, maybe these competitors, they're offering these off brands and, it's not as attractive as the P&G brands. But, in an economy where, things are going down and, people are feeling the pain in their pockets, they would want to buy those off brands. So just let that sink in for a minute. And I hope you guys enjoyed this video and have a good one.